Hey guys, what's going on? It's Henry, and in this video I really want to show you what's going on in my portfolio. So right now I have a lot of options expiring 6/23, and I just want to be transparent as possible. I want to show you my wins, my losses. I personally don't care because I don't really care what people think. I'm just trying to teach you the actual facts of what's working for me, what my thoughts are, and my unique strategy. And basically my unique strategy is very lazy and very boring. That's the way I like it. I don't want to deal with people that are losing money. I literally want all my clients to have the most boring, consistent results, so none of them ever bother me. Yes, I'm selfish, but hey, at least I am honest and I'm very straightforward on what my strategy is. So as you can see right here, 6/23, I have all wins. All my positions are currently making a lot of money, and I'm always showing my wins and my losses. I have tons of losses too. Here and there I have losses. I'm not perfect. My win rate's around 95%, and 5% of the time I am losing money. I have losing trades, at least once a month. So just being super transparent with you. But if you want to see all my trades, it is the first link in the description. And actually, as you can see on my calendar, I always have about 2 days in advance where you can book a time either with me or someone on my team. I have 2 different partners, and we can all talk about the Discord community and what we have to offer. But essentially, you can follow every single trade that I'm doing. And as you can see right here, I have quite a bit of trades expiring this Friday. So I'm always pretty much going for weekly options, every 2-week options. I'm also going for options that are monthly, quarterly, and yearly. Now, why do I do that? And as the title of this video pretty much points out, which is managing risk. Part of managing risk is actually 2 things, okay? First of all, you want to have many different positions in your portfolio, right? You obviously don't want to have just one stock and just one option. That's really dumb. And you don't want to have just one strategy either. You don't want to just buy call options. You don't want to just do covered calls. Although just doing covered calls is also okay, and it's actually quite profitable, and selling puts is really profitable. And the wheel strategy is my very favorite strategy, so there's nothing wrong with that. But if you can diversify and have different strategies in your portfolio, like you're utilizing spreads, you're utilizing iron condors, you're utilizing other strategies that I talk about in my small account playlist as well, which you can watch here on YouTube for absolutely free. If you're utilizing all these things, you're gonna get the best returns because you honestly wanna diversify as much as possible. And one thing that I personally consider diversification, which honestly nobody really talks about, is expiration days. And I always get this question like, Henry, what is the best expiration day? And I always tell people, well, let me get my notebook out and let me ask Goldman Sachs and all this experience that I have. Let me see what the best day is. It's 6.5 days. No, it doesn't really work that way, okay? There's no exact answer, okay? Anyone that tells you, oh, this is the exact answer, they are trying to just sell you some nonsense BS and probably make money off of you, okay? And there's no good guys. I also sell a Discord. I want to help people though, and I'm very real, and I'm not going to BS people. I'm telling you honestly, there is no perfect answer, okay? There's no perfect expiration day. There's no perfect stock. There's no perfect strategy, okay? Everything has pros and cons. This is life, guys, okay? Everything has benefits and everything has detractors. Nothing's ideal. There's no ideal people, right? Don't we all have some arguments with our loved ones here and there? Like we love them and we also hate them, right? Well, the same thing is with option trading. And that's why I decide to go for many different expiration days. For example, okay? Weekly expirations are really cool and they're really good because you get quick results. You get to see exactly what happens like right away. So it's like really exciting. You get to see what's going on and you're like, whoa, this is really cool. I'm winning, I'm losing, etc. And the theta decay is also very high, right? So theta is something that an option has, which is basically like the decay of its premium. So say that an option is worth $1 and there's 5 days until expiration and the theta is 20. Well, every single day, it's basically making you $20, which is really cool. Now, if you sell an option that's like 1 year out, then that option is going to have a really low theta because if it's worth $1 and it's out 365 days, 1 year, right? It's basically going to make like, nothing, like 30 cents a day, right? Something really, really small. So the theta is very low on that, but there's other benefits because when you go out really, really far, then you're actually going to collect a bigger raw premium collected, right? Because there's more time and that's going to be factored into the option. Now, also, if you're doing something like selling a put option on SPY, right? And you do it 3 years out and you do it really low, you can actually make a really safe return and SPY is not gonna fall by like 30, 40% in 3 years. So that's really easy money, but you have to wait a really long time. Now, if you go for quarterly options, then you usually capture in earnings and there's some risks there. There's also some benefits there because if an option is basically capturing in earnings, then that option is going to be a little bit juicier because the implied volatility is higher, and the implied volatility is higher because investors know there's going to be an earnings event that is going to be captured inside that option. So for example, like Tesla, if it has earnings on, I don't know, July 25th and the option is expiring in August 19, the traditional third Friday is typically the expiration that I like. That's why I also like trading monthly options, because those monthly options have really good open interest, really good volume, and really good bid-ask spread. And that is really important. Those three things, please take notes, because that's really important for you to cut down on fees, because a lot of people, they don't think about it. They don't think about the fees. And even if you're trading on a free brokerage, there are still fees, because essentially the difference in the bid-ask spread is what you're kind of losing in slippage cost. So I really like to pay attention to that. And for me, that's why there is a problem with really short-term options. And that's why I honestly don't love zero DTE trading. Although I will have to say that in my Discord community, we actually have zero DTE meetings. And there are a lot of traders in my community that are trading zero DTE options. And especially the folks that have, 50K or higher, they're able to make a lot of money every single day without having to hold the option overnight, which they absolutely love, because then I guess they get to sleep better at night. But still, for me, there's a lot of pros, there's a lot of cons. I'm actually not a huge fan of 0 days to expiration, because essentially I'm really cool holding a position that I like even overnight. Heck, 252 nights of trading days is fine with me as well, because, well, if you like a company and you're doing a covered call, not really that much can happen. Yes, it can fall, but all the stock investors would end up losing and getting hurt as well, where you have a covered call, then that's fine because you have a cushion. So if it falls, fine. If it goes up, which is pretty much the situation right now since the market is really bullish, people are all, kind of upset. They're like, I only made 12% in the past month, and Nvidia is up 52%. Well, I'm like, hold on a second, guys. Let's take a step back. I'm not like, crazy about this, but let's kind of check ourselves a little bit mentally, because look, if you made 12% in a month, you have to go kind of pat yourself on the back. I mean, that's a really good return. The S&P 500 doesn't do that. If you made 12% of your money and you have 100K, that's $12,000. That's pretty much what a software engineer makes, right? Some really good professions out there, they make $12,000 a month. So I get it. Sometimes when people see a covered call, it goes into the money like, I could have made more. But also you have to understand that some months they're going to be negative, and then your covered call is going to really outperform what the stock does. So the stock could be down 10% and you're only down 3%. So you ended up saving 7%. So at the end of the day, it's all going to balance out, and you're going to have a big profit on your hands if you're doing covered calls correctly, which I pretty much do every single Monday and Wednesday in my Discord community. So again, go ahead, book a call for that. I'm always being really transparent with it. Now, I also want to talk about mixing it up with volatility, because high volatility is really cool, but one of the biggest mistakes is chasing high volatility. And I see this all the time. People look at implied volatility like, I want to get the highest implied volatility, I want to sell those options and make a lot of money. Okay, it is really cool, and I really like people that have my mindset, which is they want safe, passive, consistent income, and they want to collect big, juicy, fat stacks of premium. That's great, right? You all want consistent income. That's fantastic. I love traveling and spending money on luxurious things. Like yesterday, I had black caviar. Spent a bunch of money on that, and I love consistent income. But here is the problem. If you're chasing the fat stacks of premium because you want to live a luxury lifestyle, or you want to retire really, really fast, and you're kind of like chasing it, you're kind of being desperate about it, well, you are going to get hurt, because anything that you chase too hard and that you over leverage yourself and you put in like a little too much risk there, it's not going to end up playing out. You got to relax, because if you're chasing the highest implied volatility, you are going to eventually get crushed, and that's going to be one big loser. And you already know one big loser can wipe out 10 small gains. So you really need to practice safe risk management, which is why I tell people all the time, being part of my Discord community, I'm always doing this analysis for you. I know I'm kind of tooting my own horn here, but still, it's really important that at least you understand how to manage risk, having different positions in your portfolio, not losing money or too much money on any one position, because I've seen it over and over again. People are making great money. They're winning 3-4 months in a row, and then they have a bad month, and they basically give back all of their gains, and then they just lose motivation, and they end up quitting this option trading journey, which is really detrimental. And I've spent basically the last 10 years on this journey. I've had plenty of bad months, especially during the COVID times when the market was just going down. But you know what? I held really strong, and I made all of the money back plus a lot more. And I was in it before the whole trading craze came up, right? Because I think in 2020, everyone was home, they had lots of time. They're like, let me make some money. And they thought option trading is easy. And granted, it was easy, but it's not always going to be this easy. It's not always a bull market. And that's what separates a good investor from a bad investor. You know, a lot of people, yeah, they have a great time during bull markets. They feel, I'm a genius, I'm making all this money, I can quit my job. By the way, I saw this guy who was an engineer from my university. I went to Drexel, but then I also had some experience at Penn. I studied under a Wharton professor in economics. He's always on CNBC actually. But so I studied a lot, and I had this one student that was I think he was a mechanical engineer. He had like $125,000, and he literally, I mean, tell me how stupid this is, please, guys. Comment in the comment section. Tell me what you think. Do you guys know someone like this, or how ridiculous do you think this is on a scale of 1 to 10? Just give me a number, okay? The guy said, I have $125,000. Said, that's not a lot of money. But he said that it's going to double every single year if he puts it into Bitcoin. I said, well, Bitcoin's not going to keep doubling all the time. He's like, no, I'm an engineer. It's going to keep doubling all the time because, you know, back then it was doubling all the time. I think it was around like 10,000. And he was right for a little bit, but not forever. So he ended up quitting college, or I think he already had a $125,000 job. I kind of forget because I graduated 5 years ago. But he had $125,000. He thought it was going to keep doubling. So he said that if he would only spend 60K and then, you know, 60K of profit, but then leave the 65 in there, it would keep compounding and basically make him a millionaire over the next few years. So he basically didn't do anything, quit his job, and that was like really, really stupid decision, obviously, right? Scale 1 to 10. Just tell me how dumb that was. From an engineer at Drexel, like, where do you come up with this stuff, right? So anyways, what I want to say is you want to mix it up, and you never want to like think that the times are always going to be good. You always want to plan for some tough times. You always want to be conservative. Even though, you know, most months, let's take a look at my performance for the past 3 months here. Made 175K, about 10%, about 3 to 4% is what I basically am after. My results are a little bit down, a little bit less than usual, but I'm very happy because I just have a straight line of growth. And again, I don't really care. It's not like I'm going to be spending $175,000 anyways. I basically want to be as consistent as possible, okay? So I don't want to have huge volatility because I want to have as much fun as possible in life. You only live once, okay? And I want to make sure that I have the least amount of stress, make the most amount of, you know, health progress, most amount of social progress, and that I'm focusing on all areas of life, not just on the financial side. I want to be really well balanced, know multiple languages. I speak, you know, Russian, I speak Spanish, you know, I speak lots of, you know, I'm trying to learn other languages, but you get the point, right? So you want to be really balanced here. And one other thing that we really need to discuss is just position sizing. You want to make sure that you have 15 positions, and no single position should be more than 15% of your portfolio. Now, also, it's super important that you stick to this example on a spread on Apple that I recently made. So this example is going to be really important because it's something called a call credit spread. And I'm going to show you in just 1 minute what that's going to look like. But it's a video that I recently made. I'm going to play a clip for you because a call credit spread is going to help you reduce volatility, and also call credit spreads are actually that perfect medium. They're about 30 days of expiration is what I typically go for. And that's a combination of a really high return and very little work. So I'm setting the position and basically just forgetting about it. And the reason why I love spreads, the reason why I honestly just love selling options in general is because I'm really lazy and I'm just after freedom. I am after making the most passive income possible. That's why I don't even mess with real estate. I have, you know, multiple portfolios. I could afford to put down payments on like 5, 10 houses. I do not want to deal with any tenants. I don't want to deal with anyone. I just want to trade. Of course, I have lots of students and I'm more than happy to work with them because I love it. Okay, I enjoy it, but I don't want to work with anything that I don't personally want to do. I want to have freedom. So that's why option trading is amazing. And then also it's a really low time investment. Honestly, I spend 3 hours a week trading. Monday, Wednesday, Friday, I do it on camera in front of other people. And then most of my other time is honestly spent making some content for you guys, which is not a lot of time. I only do that a few hours a week. And then the rest of the time is just coaching. It's just making sure that everyone that is joining is getting really good results, because I want to make sure that folks are getting up to a few $1,000s a month in passive income. And as long as they can do that, it makes sense for them to stay in the group. And then they're happy, I'm happy, and my business partner's happy, and our whole community is happy. My goal is to grow the best option trading community that's the most consistent. Now notice, not the richest. I don't care about being the richest. I want to be the most consistent. I don't really care about, I can already get a Lambo, but I don't really care about this really fancy stuff, right? I don't have, I have some watches, but I'm not going after super fancy. I'm a very simple person. I grew up with nothing. My parents are from, Ukraine, Russia, that type of area, Eastern Europe, right? I speak Russian. We're from that area and we grew up super simple. So I don't need a whole lot to be happy. I'm just very simple. I want more experiences in life. I don't need more things, okay? Of course, I want to support the people around me and I want everyone to be comfortable. I want to be a provider. I really love that, right? And I think that is very noble for many men. And honestly, there's nothing wrong with being a strong, independent woman as well, right? That's really cool. Having money, being able to support yourself, contributing to your family, beautiful, right? Fantastic. So that's why I want it to be really low time investment and really consistent. Again, I don't care about making $1 million and being on a boat. Doesn't really excite me. It's cool, right? Jeff Bezos, cool, but I don't really care, right? And then also just being location independent. So I really love going where I get treated best. So that's why I'm not in the United States because, there's a whole lot of issues, right? What kind of issues do you guys kind of see in the United States, right? I'm kind of curious. What do you think? So comment in the comment section below. Like, what do you think are some common issues in US? And feel free to be a little bit political. I'm actually really curious what your guys' thoughts are. But I personally think that there's a whole lot of negatives, right? I mean, there's no perfect place, but that's why I'm decided to just travel to other places, South America, Europe, stuff like that, right? I want to have more experiences and I love being location independent and not being tied down to any job or any desk or anything like that. So love going where I am treated best, basically. So now what I want to show you guys is watch this example on Apple spreads because I think it's going to take your option trading to the next level. The way I maximize my income is by putting 10% of my money into credit spreads. I strictly only trade call and put credit spreads, especially if you trade 0.15 delta spreads. You always win. It's one of the greatest option strategies of all time, especially for scaling portfolios quickly. So check this out. Call credit spreads are amazing in market environments that are bullish but peaking. They collect massive income during these times if you pick the right strikes, like I'm going to show you. If you leave a like on this video right now and comment put credit spreads, that's going to be the next video I'm going to make. Call credit spreads are a specific type of credit spread strategy that focuses on call options. When constructing a call credit spread, you sell a call option with a lower strike price and simultaneously buy a call option with a higher strike price. The objective is to keep the price of the underlying asset below the sold call strike price at expiration, thus maximizing your profit potential. Okay, I have a lot of these positions open and I am doing really well, so I'm going to be showing you examples in this video. Before I show you an example, you need to know that this is a defined risk trade. Unlike buying naked call options, call credit spreads limit your risk. The maximum risk that you really have is the difference between the strike price minus the credit that you receive. For me, I usually like to do $500 spreads, but for some others, especially if you have a medium or a small portfolio, a $300 spread is completely okay. However, I'm going to be completely direct and honest with you. I do not like $100 or $50 spreads. In fact, they are good for really tiny portfolios, but there are costs associated with them in downsides. $500 spreads and $300 spreads are ideal. And this is the most perfect strategy for scaling a portfolio. Learning this has so many benefits, and I have a lot of these positions currently open in my portfolio. For example, I currently have an Apple call credit spread. Now, it is currently showing a $280 loss, but I have many of these positions, and over time, they have brought me in so much money. In fact, I've been able to make about 2 to 3% per week and about over 10% per month on call credit spreads, especially if you factor in the longer term picture, because yes, the market can be bullish, and this is not an ideal strategy when the market is just going straight up. I mean, if the market is just rising like crazy, then a call credit spread can get hurt. I'm being honest with you about the risks, okay? So listen up. But look, when the market is high and the RSI and the technicals, which I'm about to show you, is high, or the Bollinger Band is high, or the technical indicators that you look at are high, then call credit spreads are literally perfect. And even if the market is going sideways, a call credit spread is still a really good strategy to implement. And I'm going to show you an example on NVIDIA, because any stock that goes up a lot a call credit spread is a fantastic time to start making money on a stock that is likely peaking or near its peak. This is a very low risk strategy if you follow the rules that I'm going to teach you. Okay, so as you can see here, I also have an Airbnb call credit spread. So let's actually open up a call credit spread so you can see the exact mechanics of how I would open this position, how I would close this position, manage this position from the very beginning to the very end to make the most amount of money. All right, so check it out. The first thing that I want to show you is going to be NVIDIA. NVIDIA is a really hot stock. It's obviously benefiting from AI. There's a lot of good news, but look at this stock's technical pattern, okay? This stock has gone right to the moon from about $146 per share, up more than double. In fact, double would have been $286, but now it's over $391. But as you can see with the Bollinger Band, it has exploded higher. I have not participated in the stock going up as much as I would have liked. However, I've been actually making really good money by doing, as the title says, call credit spreads, okay? Because when a stock looks like this, so see how this stock just had a straight momentum higher. It had little slow periods, but it just continues to go up and up. But now, as you can see on the short-term period, if I go to 3 months right now, you can see how the stock is actually stalling out. I mean, literally, it actually went up to above 400 and now is just trending sideways. And the Bollinger Band now shows 438 as the peak. And this is basically the Bollinger Band at its very best. I mean, literally, the Bollinger Band has expanded so much to account for all of the implied volatility that the current stock is showing. So now that you kind of understand that the top of the Bollinger Band is 438, and by the way, the best practice for the Bollinger Band is just to keep the very basics that Yahoo Finance is recommending. So the period is going to be 20 days and the standard deviation is going to be 2. You can do 3 standard deviations. That's going to even widen your Bollinger Band and give you even more safety, but 2 standard deviations is already about 95% of the data that you're supposed to see. So there's only a 5% chance of something going wrong. You can't be perfect in trading. I am not perfect myself. I make mistakes all the time, but if I can win about 95% of the time, and I'm able to do that on a very consistent basis and achieve passive income, that is my goal. My goal is not to be a full-time trader. It's not to have a lot of volatility. It's to be the steadiest trader out there, making a consistent, for me, that's $2,500 per day. For you, it could be $100, $300, or $500 per day, or even more. You're able to dream as big as you want. You really need to understand that option trading is the best opportunity that I've ever seen in terms of passive income and investing. So now that I've looked at the technical analysis slightly for NVIDIA, and we now know that the stock has gone up like crazy. I mean, over this 6-month period, this stock has literally went to the moon. And yes, as you can see here, the moving average is also coming up a lot. But honestly, this stock is peaking in my opinion because it can't just continue going to the moon. It can't become, more valuable than Apple because it doesn't deserve to be there yet. So it only makes logical sense that this stock, yes, it can increase, but in the short term, I do not expect it to go above $438 per share. So now what I'm going to do is I'm going to open this up and take a look at the options themselves and just point out what are the best practices and then how we're going to pick a strike price. And you probably already have an idea of a good way to pick a strike price is by using technical analysis. As you can actually see here, I already had a call credit spread that is expiring pretty soon in the middle of June as I'm making this video. But this video is relevant for you to watch way into the future because this never changes. If you understand how to do call credit spreads correctly, you are going to collect consistent income and your return will far outweigh your risk. Not to mention, this is one of the best strategies for scaling your portfolio and growing it very quickly. So as you can see right here, I have a position that's expiring. I currently sold 445 and 450 call credit spread. So that's actually a little bit higher than the Bollinger Band. And as you guys can see right here, I've already made $220 for a 95% return. This is about a $5,000 cash collateral. So this percentage return right here is going to be about 5%. So I'm aiming for 5% on this position in 2 weeks, okay? 5% in 2 weeks is going to be about 10% per month, which is going to help you double your account every single year. Now, that is really important because if you can double your account in 1 year, you're basically better than Warren Buffett and the rest of the billionaires on Wall Street. So this is a very huge return. And obviously, you really need to understand risk management. Okay, let me just pause for a second because the most important thing with risk management is you have to have no more than 10% of your money in any one trade. You should have at least 10 positions in your portfolio. If you put more more money than that in your portfolio, you are at a significant risk of having all of your eggs in one basket. And if one position blows up, your portfolio will suffer a lot. Me personally, I don't want my portfolio to suffer, and that's why I have at least 12 positions in my portfolio, unless there is an exception to the rule, unless I am trading SPY or Triple Q, because those two ETFs have so much inside of them that they already have built-in diversification. Now let's take a look at NVIDIA. I'm going to go to trade NVIDIA options. I already have the 445, 450 call credit spread, which has made a lot of money, but I want to open up a new position and show you how I would continue making money. And if you're watching this in the future, this is a fantastic thing to understand, because you can always use my logic, copy and paste it for a future event on a stock like NVIDIA or any other stock that is looking like it's peaking, or it's at the top of its Bollinger Band, or just in terms of technical analysis, a stock being expensive. And also, I didn't mention, but fundamentally, a stock can also be very expensive. And you can look at the price to earnings ratio, you can look at the price to sales ratio to get an understanding that a company is overvalued, okay? So the first thing that we want to do is we want to go to a future expiration date. For me, sometimes I go weekly, but honestly, I'm a big fan of passive income, enjoying life, and collecting a lot of income without working really hard for it. So for me, I have no problem even going 2 months out. So this option right here is 67 days out. And if I can collect a good premium and not do anything for 67 days, and my risk management is basically like, this is about 5% of my portfolio, and it's not very volatile, and I've collected a lot of income, that is a perfect case scenario. Learning this strategy has a lot of benefits because it's so simple, it scales, and this passive income is something that I really like over active trading. And I also want to mention that I do have a Discord community. It's the first link in the description. A lot of students of mine are full-time traders. If you're interested in making a full-time income by only working a couple hours a week, then that is a good program for you. The best thing to do is schedule a call, because not everyone is a fit, and we want to make sure that we build the best custom program for you in terms of coaching with me. So before I talk about closing this position and managing it, obviously we have to open this position. So the first thing I'm going to show you is basically you start off this position by selling one call option. It's very important to sell the first call option at a proper strike price. So now what would a proper strike price be? So for me, again, I told you that the Bollinger Band is 20 and 2, and the top of the Bollinger Band is 438. So if I can do something around 438, that is going to be the sweet spot for me, because I know I'm going to win this trade 95% of the time or more, okay? So what I'm going to do is, since it's 438, I'm just going to go ahead and pick something that's higher than 438. I can pick 440, and let me tell you, that would be okay, and you would probably make money. But the delta right here, I just want to point out, is 0.28. That's not really a low delta. This delta is fairly high. That means you're going to lose about 1 out of 4 trades. I don't want to lose 1 out of 4 trades, but you can already tell that this is already a very huge advantage, because the Bollinger Band says this is a 95% chance of not happening, meaning that you're not going to go into the money, and you're not going to have to manage this trade, close it for a loss. You're going to leave the trade alone and let it expire and collect the full income from it. Okay, so what I'm going to do instead though is I could pick 440, but I can already tell you right now, this is a beautiful trade with lots of premium, but it's slightly risky and has a good amount of volatility. So I don't want to have that type of position. I'd rather go a little bit higher to something like 450. Now you can see the delta is coming down. I can go even higher to 460. You can see now that the delta is around 0.2. So I like this because now I have about an 80% chance of winning based on delta, and a 95% chance of winning based on the Bollinger Band. So for me, this is a beautiful position, okay? Taking a look at the volume. The volume is 182. The open interest is 669, which is not bad, okay? There's healthy volume. There's healthy open interest. Now, taking a look at the implied volatility, it is 42.29. For me, I like implied volatility anything above 40, okay? Now, too high, if it's like 100, that's also not a good thing, because something at 100 is just way too volatile, and you probably have to kind of scratch your head and say, hey, like, is there going to be an FDA approval? Is there like a debt ceiling, or like literally what's happening? Why is it so high, okay? There's something off about that. But between 40 and about 80, is a perfect sweet spot of high implied volatility and very good premium to be collected. So right off the bat, the bid-ask spread is not ideal, which is AKA why I also want to go a little bit later in terms of expiration. I don't want to do weekly expirations where the bid-ask is so wide, because every time you trade, you are losing a little bit to a market maker, someone who's making this market and basically buying it for 745 and selling it for 815. You're going to get somewhere in between, right? You're not going to get the best price for this unless you have some advantage through software. That's just not possible, okay? Unless you work on the New York Stock Exchange and you buy a seat on the table of the New York Stock Exchange, you're not going to get these perfect prices. So that's also why I like going out a little bit further in terms of date for call credit spreads, and especially for strategies like iron condors. But look, so I'm going to go ahead and sell this 460. Now what I'm going to do, just off the bat, if I sell a 460 and I don't do anything else, this is called a naked call option. I would never ever recommend you do a naked call option because the risk is unlimited. As you can see right here, the maximum loss is unlimited. I would not recommend this. Flat out, I do this with very advanced students who have over $250,000 in their portfolio. But for most people, what you want to do is you want to now go ahead and buy another call option that is higher than the 460, okay? So we have 460. Now what we want to do is, again, go for that perfect $5 spread or $500 worth of collateral, which is a small account trade. Beautiful, right? 460. I sold. Now I can buy the 465. And what you will notice right here is that the ask price is actually $745 and this is $745. And that's the negative thing with options sometimes, is you really have to look out for liquidity, okay? So the liquidity here is not ideal. And again, talking about the difference in the bid-ask spread, it is not good because the difference is about 65 cents. So the difference here is 65 cents, and here it was also about 65 cents or even more than that. So that's an issue because, there is a price to that. However, you will notice that the maximum profit is still 68. So the market isn't dumb. They're not going to give you zero for this trade. You're still getting paid a decent amount. You're making $68 and you're risking about $432, which is roughly a 1/7 return or about 14% in 2 months. So 14% in 2 months is about 7% in 1 month. So a 7% return is going to scale your portfolio very quickly, but there's a few more things that you really have to understand to making this position work, like managing the risk around it and then actually managing to close it for a profit, okay? So here's the thing, when you actually go ahead and click continue and place this trade, you will notice that the bid is 0 and the ask is 135. But that's okay because you can still get the middle point, which is about $68. Now, once you open up this trade, the money enters your account immediately. So with this $68, you can go do some grocery shopping, pay your electric bill, or just continue to scale your portfolio with this new premium. Okay, it enters your account immediately. Now, what you will have to do though is you have a position that is open in your portfolio that's going to show you a negative $68 balance. So that's why your balance doesn't change, but your cash will change as soon as you open this position. But the only thing that you really have to do is just kind of monitor this position. And what I mean by monitor is go live life, don't really look at it, but just keep an eye out once in a while to make sure that it is not going into the money. And the good news is that the strike price that I picked is 460 and currently Nvidia is at 391. So there's a very low chance that this stock is going to go from 391 to 460 in a snap of a few fingers, right? So what you can do is you can basically ignore this position, continue to make passive income, and only look at it maybe like once a week would be my suggestion. So if it actually goes into the money or near the money, you can start thinking about rolling this higher. Now, I'm not a huge fan of rolling spreads higher because there's also fees involved. And just in terms of management, I like to keep my management as low as possible. So the highest statistical return that I've learned after working at Goldman Sachs and talking to many mentors, including having a mentor on Wall Street, having a mentor that worked at Wharton, the Wharton School of University of Pennsylvania. They've all told me that basically less management is more ideal. So what I would like to do with this position is I'd like to hold it up until August 18th, unless it goes into the money. So if it goes to like 462.5, like it's in between my two strike prices, then it's really important to kind of ask yourself, do you think the stock is going to come back down based on technical analysis and fundamental analysis? If you think it's going to come back down, then it's okay to hold. But if the stock is clearly showing a very strong momentum, which I would really doubt with this type of position right here, this position is going to work out. In my opinion, I would totally feel comfortable to open up like $50,000 without a problem. But if it does go into the money, then what I'm going to do is I may close this trade out, just call it a loss, call it quits, and just keep moving on in life. Or if I feel like this stock could potentially be peaking and in the next future period of 1 month to 2 months that it won't go any higher or won't go too much higher, then you can also close out this position and then open up a very similar position, basically rolling this position higher. So you can roll it higher from like 460 and 465 to something like 490, 495. You may not get enough premium to compensate you for the loss, but you will still collect more income and reduce your current loss on the position. Now, again, I don't really expect to have loss on this position, and if it happens, so be it. I have losses every, 1 out of 20 trades. That's just part of being a professional trader. And not even a professional trader, just a retail investor. We're all gonna have losses. Where people make the biggest mistake is position sizing. So people literally don't understand position sizing. They fall in love with the position, they get super emotional about it, and then they end up opening like 25, 30. Gosh, some people open up half their portfolio in one single spread, which I think is absolutely insane. You do not want to open up too much of your money in any one position. Now, if you have 20 different spreads, and by the way, you also have to have put credit spread, so don't forget to comment put credit spread in the comments if you want me to make that video. You have to have both. You can't just have only call credit spreads, because if the market is very bullish, then you are going to end up losing money. And we don't ever know where we truly are in the market. Nobody can truly predict the market. That's just never going to happen. So that's why you need to have call credit spreads and put credit spreads in your portfolio. But one of the most important skills that you have to have is rolling. And I just made a rolling video that you have to check out right here.